Hello and welcome to the Mutual Fund Show. My name is Neeraj Shah. Over the next 25 minutes, we'll try and give you a perspective into funds which have done well from categories which have seen the maximum churn. Now, what do I mean by this? Over the course of 2019, there were certain categories which saw a lot of inflows into those categories at large over the year, or saw significant outflows. Now, think about a fund which has done well in a category which has seen maximum outflows, and you would believe that that fund would have done something right in order to do this well. And then, of course, we talk about what could these funds do going ahead as well. Or conversely, think about categories which have seen a lot of inflows, and amidst all of that money coming in, if a fund or funds have managed to stand out, then surely they have done something right. So to talk about this nuance about categories which have seen the maximum churn and funds within those categories, we have with us Bhushan Kedar, Director at CRISIL Research. He joins us on the show. Bhushan, good having you. Thanks so much for taking the time.
Yeah, good afternoon, Neeraj. Thanks for having me on the show.
So I was looking at the table, and some very interesting categories which have been very, very flat. Particularly, value, contra, or mid-cap funds, etc. Hardly any movements there. But there are a clutch of categories which have seen massive inflows or outflows.
Right. So sure. So I think let's look at recap 2019 in terms of performance. And if you start with different capitalization stories, I think large cap has done well. They have delivered about 12% return. If you go to top 100, it's about 11% or 1% lower. If you look at the mid cap, are basically almost flattish or negative by half percentage point, and the small caps are negative about 0.5%, I mean negative. So that's been a story overall, if you look at some of the key indices. Within that, what really draws attention is some of the funds that, you see on, multi-cap, etc., where you actually seen, inflows coming in. AUMs have grown, and clearly the AUMs is a factor of two things. One is the performance they have delivered, and two, the inflows that have, come into the system. I think in some of the categories we've seen those, inflows coming in. I think amongst equity, I think multi-cap is the category where we've seen largest inflow, about good 110%. It's almost doubled. So we are talking about, it's about a 75,000 crore category now.
Yeah, well, that's the table on your screen and shows clearly how multi-caps have seen some dramatic inflows. Focus funds haven't done too badly. ALSS, I believe, would be standard and static. This would probably be a number that could be happening almost every year because people put in money into tax-saving funds, so that's not a bit of a surprise. What's also interesting is that banking and PSU fund has actually seen quite a bit of growth in AUM and inflows. And at the same time, credit risk funds have seen maximum outflows. So the non-equity side, you have the credit risk funds which actually have seen some bit of an outflow. So this is, of course, the equity category, and which is what we've spoken about. Now look at this, the other set of numbers. And as you can see, the banking and PSU fund, 1 year AUM growth is about 134%. And then if you move on to the others, credit risk at the bottom end of your screen is down about 25%. I can understand the outflow from credit risk funds with all reasons. But before we move on to the specific categories, this number in the banking and PSU funds, quite staggering, the kind of growth that we've seen there.
Yes. So clearly, if you see at a aggregate level, there has been a growth in the debt, AUM. If you put all sort of categories together, so there is an investor. Both non-retail is the large portion there, but the retail one, I think they have been, there. If you look at the number of folios also in some of these categories, have been very, very stable. Okay, so either there is a growth or there is stability that the funds have achieved. It is just that the question that people at the beginning of the year or during the year have asked themselves whether they want to stick with credit risk fund or they want to move to some other category, and then people have shifted to different schemes. So more or less the money has remained in the system, and hence you see growth in some pockets, probably degrowth in some of the other. And two, people are also taking bets on in terms of duration, credit risk, wherever they are seeing good quality portfolios. I think the money is sort of shifting there.
Okay, so let's talk about these categories and start off with the multi-cap fund categories. Now, it's arguably an option which gives an investor a chance to invest across market caps, and therefore that should be a favorite too. But it's seen substantial flows. a word on the category and how it's done, and then the funds that you want to talk about in this category.
Sure. So, in terms of, AUM growth, we've already spoken about it. In terms of performance, the overall category has delivered about 9.5%, if you put together all the funds in that category. That exactly maps to what Nifty 500 has really delivered. So basically it represents all capitalization to begin with. Now the investor is leaving a choice with the asset manager or a fund manager to take a capitalization bet. Now whoever succeeds taking those capitalization calls right turns out to be an outperformer. So in this case, we spoke about the number. So anybody who had more allocation to large cap would tend to outperform, and somebody who actually allocated lesser to small and mid cap would also benefit from protecting the downside. So I think that's really the story if you look at last 1 year on the multi cap side.
Yeah, and this there's some interesting names out there. Some traditional favorites, some which are coming up new. The preferred funds that you have out here, which is one, the Kotak Standard Multi-Cap Fund, the growth option, as well as the DSP Equity Fund, the regular plan, the growth option, both of these multi-cap funds. Can you talk about why is it that these funds are finding a higher mention within the CRISIL ranking frameworks? I'm guessing that these are the funds which enjoy decent rankings on your ratings or ranking framework. Yeah,
absolutely. So I think both funds are featuring here, and the reason why we're talking about them is one, outperformance vis-a-vis the bench, the peer set. The Kotak delivered about 13% vis-a-vis 9.5% over last 1 year, and the DSP fund delivered almost 17%. So one, they have been very good performers, in recent past. Besides that, across other parameters, be it concentration risk, etc., they have been faring fairly well there. So keeping their ranks in one or two, top two ranks basically. The key drivers, if you really drill down, and the reason that we spoke about, how do you allocate amongst capitalization? So Kotak, fund, what we have seen is, though their allocation to large cap and mid cap is very similar to what you see as a peer average, okay, which is about 70% and maybe 15%. But I think where they've benefited is lower allocation to small caps. So they have made about, on an average, about 2% allocation to small caps. And the remaining, probably it's a tactical call, about 8 to 10% has been allocated to cash or debt-like instruments, which has really helped them protect the downside on the small cap. Okay, that's, I think, one clear reason. If you look at the DSP fund, they really don't have very differentiated allocation strategy, but clearly some of the outperformers that they have been able to pick. And if I was to just talk about some of the names, I think Bajaj Finance, ICICI Bank, Avas Financial, which generated almost 130% return over the year, or ICICI Lombard General Insurance, about 65% return. I think these, some of the stocks that have they have had allocation to 2%, 3%, etc., have really done well. I think that is something which has played off. And lastly, the conviction rate, if you really see in terms of your ability to stay put in a specific stock, I think both of these portfolios, you will see the ratio is almost more than 70-75%. So they are not really taking out those 70-75% of the stocks, and 50 to 60% of their stocks on an individual basis have also beaten the benchmark. So I think both of these strategies have really gone well. They have been able to stick with the stocks, so minimal churn, and at the same time strategies that have been able to outperform the overall benchmark. And thirdly, the sheer outperformance, some of the names we spoke about.
Yeah, but there's a distinction between the two. In that, I think Kotak has, if I understand you correctly, Kotak has benefited because they have taken this tactical call of not betting on small caps and being in debt, which is not a very, in the sense, it doesn't involve too much of stock picking ability, but more a tact that they've taken, as opposed to that DSP somehow have managed to bet and allocate large swaths of money into the right stocks.
Yeah, that's right. And in fact, I think some of the stocks, and we spoke about some of those names, I think they've been able to pick it up at right time, stay put with the stocks, and been able to benefit from those portfolio because of their performance. And two, with regards to, I think, the tactical calls that we are talking about, so long as they remain tactical, I think it's fine. But you wouldn't want a lot of idle cash sitting in your portfolio, because when the markets sort of come back in those segments, then you are likely to not really perform well. And two, there's also a choice of picking up more defensive stocks like pharma, FMCG. So allocation to them is also something needs to be given a thought to.
Yeah, you're not giving money to a mutual fund to put that money in cash for sure. Just one last question, Bhushan.
Sure.
How have these funds performed for the year at large? I mean, they may have, in the latest rankings that would have come out in September, they would be amongst the top, but have they maintained their positioning, maybe not at number one, number two, or number two, number three, but have they maintained, been in the top quartile for a better part of the year? These two?
Yeah, absolutely. So they have been able to either, rank one or rank two, throughout the year. And I think that's the reason why we are basically talking about them, that how consistently they've been able to stay put. And we spoke about the attributes, so why they've been able to achieve that.
Yeah, viewers, please remember that past performance in most cases is not an indication of what the future would be. So what is done well in 2019 may not necessarily do well in 2020, but there is some bit of derivation that one can draw out of the nature of the allocations and the kind of positioning that their funds have done, fund houses have done, which might lead you to believe that maybe the chances of them doing well might be high as well. So these are a couple of names that CRISIL believes have done well. Well, you got to do a research about whether they'll do well or no going ahead. The next piece, and that is bordering on thematic funds and the banking and PSU funds and the kind of inflows that they have seen in the year thus far. Quite staggering. What are your observations there? How do you think the category will do? And then we'll of course talk about those individual funds.
Sure. So I think we should, if we could just spend a minute or two on just talking about how our debt as an asset class has really performed. So if you see, because there have been series of cuts by RBI on the policy front, that has really led to a rally on the interest rate side. If you look at GSEC, 120 basis point is the easing that we've seen. Similar rally we've not been able to see on the SDL bonds. Of course, they have eased, but about 90 basis what they've eased. So the spread contraction, I mean, so expansion has happened about 30 basis point in terms of for SDLs and bonds. But nevertheless, investors for bonds as well as government securities have benefited. Definitely, if you are on the longer end of the curve, you tend to benefit more when the rallies take place. If you talk about banking and PSU fund as a category, the play that most of the funds really have there is they have been banking on the relatively safer names or relatively safer sectors or subsectors on the debt side, and we're talking about PSUs which have actually shown consistency in terms of asset quality. There has not been a deterioration that you would have seen in any of the PSU names so much. What we've really seen in some of the names like PFC and REC, there has been a spread that has basically gone up, primarily because of people are seeing concentration risk because the entities basically have got merged, and that's really a reason. But besides that, from a credit standpoint, they've been quite stable. So from a safety standpoint, investors have really opted for this category, and what we've seen is, the assets have grown by about 134%, during the year, and touching about 65,000 crore. Now, pure inflows, if you see for financial year 20, and that's where I think AMFI started publishing this data of inflow at each category level, and we are seeing about 7,000 crore is the inflow that in this category we've seen. Because of the rally that we have seen in the interest rates, the category itself has delivered about 11.25% return, which is very, very, very good. So it basically comes because of two reasons. One is the interest rate rally plus the coupon that you make on top of that. If you are not having any slippage on the credit side, you are basically everything goes straight into your return. So I think that is one important aspect on this category.
Okay, and how do you expect this to be? Simply because while we talk about the debt category, one thing is the interest rate cuts that have happened and so on and so forth, and the commentary thereof, and there is a bit of a pause out there. But two, our own version of Operation Twist and what that has done to the long end in the last 3 or 4 sessions, and what it could do, because the market expects that this might not be the only thing. There might be more such operations done in the future.
Sure. So there have been, reasons on both sides, either for hardening or easing interest rates. So there have been interventions, by the Reserve Bank. At the same time, concerns on the inflation side, maybe driven by crude prices, etc. So it's going to be, in that sense, likely to be volatile. There will be policy cuts are expected. So if they were to come in next, say, quarter or two, they will, to that extent, bring down the rate. But some of the inflation concerns may sort of push it up a little. So it's going to be you could say probably a range bound but volatile sort of interest rate environment. Are they in for rallying the way we've probably seen? The answer, most likely, no. They may not really rally so much, but at the same time, they should be able to protect the any significant downside there from an interest rate hardening on something. That is something probably you're not expecting in the year to come. So whatever yield you are locking in it at, you are likely to realize that over a year's time frame is what probably you could say. So if you look at the range, maybe you're talking about a 7 to 8% sort of a range is what probably we are talking about sitting today for a 3 to 5 year asset. So I think that is what probably we are in for in the year to come.
Okay, so the two funds that you guys like, one of them interestingly has underperformed the benchmark. But just wondering, what are the rankings that these guys enjoyed in the latest rankings that would be available? Again, for the benefit of our viewers, I think these are as per September. But what are the rankings that these funds enjoy, and what do you think these funds could do in the times to come?
Sure. So we are talking about two funds here. One is a DSP Banking and PSU Debt Fund, and the other one is the IDFC Banking and PSU Fund. Both actually at the end of the last quarter are ranked 2. Okay. If you look at why we are talking about a rank 2 fund, the DSP one has been consistently ranked 2. Okay. How is it different than some of the other funds?
Precisely.
If you look at some of the other funds, have probably got ranked 1 during the year, but moved to rank 3 or something. Okay, so they have been far more volatile. And the reason why we're talking about this fund is because they have been consistently in rank 2. The other piece, which is also getting reflected in the ranks, is the kind of asset quality that this fund has really maintained. They have not taken exposure to any non-AAA sort of asset during the year. So they have been a AAA and a sovereign or overnight sort of a portfolio that they have maintained. So which basically is ensuring the credit quality is definitely top notch. And I think in terms of debt liquidity, so the kind of investment that they have made, as per our evaluation framework, turns out to be the most liquid sort of categorization, and it continues to, and it has remained rank 1 in most part of the year. So I think that is to do, that's about the DSP banking fund. If you really look at the IDFC fund, again, they've been able to maintain close to 97% assets in the AAA segment. IDFC fund actually, at the initial part of the year, had a higher duration as compared to the peers, and they were about 3.5 duration that they were maintaining. However, they've come down. So they've sort of ensured that the duration risk that they're taking on the fund comes down. So even if interest rates were to go up, they are to that extent protecting from adverse interest rate cycle. And I think from a liquidity standpoint, of course, their score has slipped a little. They're probably ranked 3. But on the sensitive exposure side, they have not really got exposed to sensitive sector as per the framework that we have. So I would clearly say consistency and good asset quality and a good liquidity, I think, are the key drivers why we are definitely talking about these funds.
Okay, you just out of curiosity, you haven't spoken about the fund which is the #1 ranked fund. That's because it's been volatile.
You're talking about the fund, Edelweiss fund?
I don't know. I mean, the one which would be #1, because you mentioned that both of these funds are number 2.
So I think Edelweiss is the fund which has now featuring in rank 1. One, of course, I think we could actually definitely pick it up in due course as we see consistency for that fund in due course. That's one. And two, interestingly, that fund has actually taken a significant duration call. So we spoke about a very tight band duration. Some of the funds, these funds we are observing, which is about 1.5 to 2.5 is the band. That fund actually has taken a significant duration call, and if I'm not wrong, that's about 5+ is what they are operating in, and complementing taking leveraging from the interest rate rally that we've seen. They've been able to benefit significantly.
Okay.
from that.
Okay. The last category, we couldn't have had any conversation on mutual funds had it not been for this. It's just that it's coincidental or otherwise that the credit risk fund has seen tremendous degrowth in AUM, in part reason or maybe in full reason due to the outflows. Now, it's not surprising. The question is, and a lot of people would want to ask, and a lot of people believe that are we at the end of the pain? What's your sense of what this category has done or will do in 2020?
Sure. So, probably over last 1.5 year post IL&FS, we've seen a series of downgrades, assets moving to sub-investment grade, taking significant haircut on their valuations, or even defaulting, and assets like DHFL have taken 100% haircut. So there has been an erosion in value in some of these assets. As we go along, the resolution plan, etc., will only determine how much is recoverable and what really comes to the investor's hand, and that probably will take some more time. From now on, clearly, what has really happened after some of these episodes, asset management companies have definitely become far more I would say far more vigilant on some of the calls that they've been taking. It's just not about moving assets to assets have moved to sub-investment grade, but it is also the hardening that we have seen in some of the sectors. So we spoke about there has been a rally in bonds and government security, but sectors like NBFC, etc., in some of the securities, the hardening in the spread has been in the range of about 100 basis points to almost 500 basis points, 600 basis points. So the assets are getting priced significantly, at lower value. So that is another reason why we are probably seeing, the erosion in 2020. Maybe I think some of the constraints on liquidity, etc., for NBFC. Probably if it continues to remain challenged, we probably will not see immediately some respite there. And I'm sure the investor is watching out for some of these granular aspects, how NBFCs and some of the other asset classes or securities are probably doing, and post that there will be an appetite for funds like that. So probably maybe couple of quarters, probably you could see this remaining maybe more static in that sense.
Okay. So maybe a couple of more months, if I heard you correctly, remaining static, but then it'll be a very interesting year for some of these credit risk funds as well. Okay, so the names that you've chosen, Sundaram and Kotak, why?
Clearly, if you look at the Kotak fund, it has really given about superior return, about 10% return, despite of the kind of credit risk environment that probably we've gone seen, as compared to 5.5% is the peer group return that we saw. If you look at couple of important aspects, what has really happened, at least the observation that we have on their portfolios, at least none of the securities that they had invested in, at least part of this fund, had actually defaulted. If you look at some of the other funds, there are about some 20 funds in this category. In most of the funds, you have investment that has either moved to sub-investment grade or has defaulted. Yeah. Now, I think Kotak is one of the funds where you have not really seen that sort of a movement, because of which they have been able to protect downside on the performance significantly and benefit from the coupon carry that they had during this period. So I think that is something which really stands out. If you look at their allocation to AAA like asset, it has been about 23-24%. But importantly, is really slippage to sub-investment grade or default is something that has really protected them from for any underperformance per se.
Okay, and of course you like Sundaram as well. So Sundaram short-term credit risk fund.
Yeah, so Sundaram clearly it was ranked 1 in the initial part of the year, and it has slipped to 5. And if you were to look at just one single security or exposure that has brought them down, is exposure to DHFL they had, and they had a significant exposure. They had about 10% exposure. So you take a 100% haircut on that, the 10% value is sort of eroded on very same day. The other thing is, in order to meet, if there are any liquidity pressures, in order to meet those pressures, you'll end up selling something which is a good quality asset, but there's a panic sell. So some of the other good assets also, there is erosion in value. I think probably that is one reason why there is a significant underperformance or negative performance by this fund.
So, but why are you choosing it then?
No, so we basically, of course, wanted to look at, we wanted to just look at, probably what has really gone wrong in some of the funds, and I think this is earlier also.
It's best to highlight this.
Yeah, it's
best
important to look at. I think
here.
Concentration risk sometimes, you're not really aware, but when things go bad, how it probably can pan out, it is important to see this, and that's where CRISIL's framework of portfolio-based parameter plays an important role.
Viewers, keep in mind, these are not necessarily recommendations in the strictest of sense by CRISIL research. They are giving out the information on some of the funds which have performed either adversely or well in categories which have seen the maximum churn in AUM. And therefore, it becomes imperative to understand why is it that maybe a select fund like Kotak would have done well in credit risk and Sundaram may have not, or why is it that in the multi-cap category there is a set of names which are ranked number 2 as per CRISIL research are still the interesting funds to monitor, and maybe some of the others have a different dimension to them. So, very interesting conversation today. And Bhushan, thanks so much for joining in and giving us this perspective. A lot of times we talk about funds which have done well and talk about what they will do going ahead, which we will do, by the way, viewers. But it's also important to try and figure out or pick funds based on the categories which have seen the maximum churn, which is what we've done today. But I appreciate your time. Thanks much for being with us on the Mutual Fund Show.
Yeah, thanks, Neeraj.
And viewers, thanks for tuning in to the Mutual Fund Show.